Okay, students, this is video number 5 on chapter 13. So I ended the last video talking a little bit about callable debt. Now we move to kind of the opposite situation. With callable debt, we have a loan that otherwise would be long-term, but you have to classify it as current because it's possible that it could be called in the short term. So it has to be classified as a current liability. Now, sometimes you have a liability that is due within the next year, but it will not have to be paid off with current assets. Now, the most common example of that is bonds for big corporations. Most big corporations have some amount of debt that they think of and refer to as permanent debt. Now, is there any such thing as permanent debt? Well, the answer is no, there is not, although the U.S. government certainly seems to believe that's the way the U.S. debt is. But what that means and the way the U.S. government works is that when bonds are coming due within the next year, then they, instead of paying off those bonds using cash that they have, they essentially refinance that debt by issuing new bonds, using the proceeds from the new bonds to pay off the old bonds. And so if that is both your intention and you show that you have the ability to do that, you do not have to reclassify that debt as current. Now, that's what your book talks about right in here. That's what they talk about right here. So let's just read this. Short-term obligations can be reported as non-current liabilities if the company A intends to refinance on a long-term basis and, notice the and, both of these have to be true, and B demonstrates the ability to do so on a refinancing agreement or by actually refinancing. Now, right up here they talk about, if we look beyond the outward form of the transactions, the substance of the events obviously supports a single continuing non-current obligation. In accounting, we refer to that as substance over form. The form of what you have is a current liability. It's due within less than a year. But the substance is, for a big corporation, the substance is that you're going to refinance that debt and you're not going to have to use current assets to pay it off. So in that case, the concept of substance over form influences the classification of the obligations expected to be refinanced. Now, for a multi-billion-dollar multinational corporation, like say, for example, Chevron or Exxon or Apple, Microsoft, somebody like that, they buy or they issue new bonds. They sell bonds all the time. And so just by the very nature of the way they are constantly creating and selling bonds and having no problem selling them, they are demonstrating that they have the ability to do that. So if their intention is to refinance that debt using new bonds, then they can avoid reclassifying that debt to current. They keep it as long-term debt. Now, for a smaller organization, let's say a smaller business, and they have a bank loan, and they take out a long-term bank loan, and it's coming due within a year, they actually have to go out and demonstrate by renegotiating a refinancing agreement or actually refinancing that they have the ability to refinance that debt. It's a judgment call that management and ultimately the auditors are going to have to make. But if a company can demonstrate they have the ability to refinance that debt and they express an intent to do that, then that debt stays as long term, even though it's due within a year. Now, under U.S. GAAP, all you have to do is demonstrate the ability. So if you have debt that's, let's say, maturing in February and you're a December 31 calendar year end, and so you have that debt that's maturing within 2 months after year end, then technically you should reclassify that as current. But if as of December 31, you can show you have the ability to refinance it, then that's fine. You don't have to reclassify it. Now, what if instead you negotiate a refinance agreement in January? Do you have to show it as current on your December 31 year-end financial statements on the balance sheet? Well, the answer is under U.S. GAAP, no, you do not. That subsequent event makes clear something that was unknown at year-end but did exist at year-end. That was the ability to refinance. So if you've refinanced the agreement before you issue your financial statements, almost messed up, said before year end, but it's before you issue your financial statements under U.S. GAAP, you do not have to reclassify that as current, a current liability. Under international GAAP, you have to have actually refinanced it at year end. So under international GAAP, if you negotiate the refinance agreement in January, then on the December 31 year-end balance sheet, you would have to show that as a current liability. Okay, let me move on down. And there you see the IFRS, the International Financial Reporting Standards requirement that the refinancing must be complete before the balance sheet date. So, excuse me, I had a little cough there. I managed to turn off the microphone before the video before I coughed, but let's go over these homework problems. So, brief exercise is 13, 9, 10, and 11. So, brief exercise 13.9, consider the following liabilities of Future Brands, Inc. at December 31, 2021, the company's fiscal year end. Should they be reported as current liabilities or long-term liabilities? Okay. So I assume we're under U.S. GAAP since it doesn't say anything to the contrary. So number one, 77 million of 8% notes are due on May 31st, 2025. The notes are callable by the company's bank beginning March 1st, 2022. So at year end in 2021, do we have to classify those as a current liability? The answer is yes, we have to reclassify those as a current liability because they are callable within the next year, and so therefore we could have to pay them with whatever assets we have available at the time they're called. So that one is a current liability. Number two, $102 million of 8% notes are due on May 31st, 2026. A debt covenant requires Future to maintain a current ratio ratio of current assets, current liabilities of at least 2-to-1. Future is in violation of this requirement, but has obtained a waiver from the bank until May 2022, since both companies feel Future will correct the situation during the first half of 2022. So, do we have to reclassify that as a current liability? Well, the answer is no. Because they have the waiver, it is no longer currently callable, and it's expected that by both the company and the bank that they will correct the situation, and so it will not be callable whenever the waiver expires. Then there's no need to reclassify that as current. So let me pull up the solutions. So number one, it's got to be reclassified as a current liability. Number two, it stays long term. And there you see the explanations. That word probable we've run across before. It's an important word. It means it's likely to happen, or it probably will happen. So unless it's probable the violation will exist, then you don't have to reclassify it. And so they're saying both expect it to be corrected, so it is not probable that the bonds will ever become callable. Okay, let's move on to the next one. So brief exercise 1310. Coulson Company is in the process of refinancing some long-term debt. Its fiscal year ends on December 31st, 2021, and its financial statements will be issued on March 15th, 2022. Under current U.S. GAAP, how would the debt be classified if the refinancing is completed on December 15th, 2021, and if instead it's completed on January 15th, 2022? Well, under U.S. GAAP, it would be classified as a long-term debt under either situation. So, under U.S. GAAP, I do not have to have completed the refinancing at year end as long as it's completed before the financial statements are issued. Now, under IFRS, that's not true, and I think that gets to the next question. So, Fleener Company is in the process of refinancing some long-term debt. Its fiscal year ends on December 31, 2021. Its financial statements will be issued on March 15th, 2022. Under current IFRS, how would the debt be classified if the refinancing is completed December 15th, 2021? Well, that's before year end, so it would be classified as long-term. If instead it's completed on January 15th, 2022, in that case, it would have to be classified as current. So, under IFRS, the debt would be classified as long-term if the refinancing was completed on December 15th, but not if completed on January 15th, because for IFRS, what's key is that the refinancing be completed by the balance sheet date. So January completion of the refinancing agreement would cause the debt to be classified as current. Okay, we will stop there and pick up on the next video from that point.